Hi. To become a better investor, you must learn from your mistakes. But which ones? There are many kinds of investment mistakes, but the biggest two, in my opinions, are first, what wrong things you did, and second, what right things you didn't do. Of these two kinds, most investors focus on the first, what you bought that you shouldn't have bought, what you sold that you shouldn't have sold. If you review these kind of mistakes, you'll eventually improve. So that's one kind of error. Remember your misdeeds and make sure you don't repeat them. However, reviewing the second kind of mistakes often provides the biggest benefit, the things you didn't do. These are often the biggest opportunities you missed. And it is that second kind I want to mention here, my own errors of omission. To be specific, I want to mention three types of such omission errors. The first type are the great stocks that were obviously great, yet for some reason I didn't buy. The second type are stocks that became multi-baggers, but which I sold after a mere double or a triple. But it's the third type of omission which often hurt the most, where I did act but not boldly enough, and so lost an opportunity. But how could this soul-searching of mine help you? It should, because at the end of this recitation, you will see how avoiding these errors can help you grab the two biggest opportunities staring us all in the face. One today, the second next year. Let's start with the great stock that stared me in the face, but that I missed, and my sheepish self-justification for it. That one is Constellation Software. It has been a 200 bagger from the beginning. I had bought it and sold it occasionally as it spiked, but missed much of it because I was never really fully invested. It is, and it's not never really cheap. This one hurts doubly because I know Mark Leonard, Constellation Genius operator, and was there when he and Dan Brown started the company. So why didn't I buy it? Because I thought myself smart enough to buy only cheap stocks, and Constellation never was cheap, so I missed it. The second type of miss is stock I held and sold too soon, mostly cyclical mini multi-baggers which involve lots of fun sleuthing, but later required paying capital gain tax on the gain, which in the final count didn't do as well as if I had bought one multi-bagger like Constellation and held it for 30 years. But yes, these were fun to sleuth. The problem was the fun worth it? Not always. What I learned was that I must develop more fun activities out of the market too, which for me is writing books. Both investment books and thrillers. Please look up the two noted alongside. Now for the third and the worst type of omission. Even when I was really sure, I often acted only halfway. Like when? Like in December 2019, just before COVID. Nearly all my stocks were screaming upwards well beyond true value, well beyond. At the same time, the fear and greed index of the market as a whole, whose range is 0 to 100, was at a lofty 95, which is as close to crazy market euphoria as you can get. And so I went to 45% cash. Great call? No. Big mistake. I should have gone to 100% cash, because every other time when the fear and greed index reached such lofty, insane levels, the market tanked, as it sure did soon thereafter in Q1 2020 as COVID hit. So why didn't I go to 100% cash? Was it old age? It probably was. Because in a similar situation in August 1987, that's 40 years ago, when I ran the research at Gordon Capital, the premier Canadian broker, a similar juncture of sleuthing and market indicators reached extreme. Then my research department and me issued a massive sell report. Go into cash, we said. Liquidity squeeze coming. A month later, in October, the market crashed, down 23.5% in one day. And Gordon, full of cash, was in the market buying hand over fist. And when 2 days after the crash, the fear and greed index reached to 10, we issued another report, From Euphoria to Panic, Buy Equities. I still have copies of these two reports. I'm really proud of them. So why did I do it then, but not recently in 2019? As I said, maybe old age, but I think I learned my lesson. In the October panic last year, I told you not to be a lemming and not to sell. That is, stay fully invested, 100%, zero cash. That time I even stuck my neck out and said that the S&P 500, that at the level of 3,500 would rise close to 6,000 by Q1 2024. It is today at 4,500, or 35% higher. What was the reason for that October no lemmings call? There were three reasons. First, Janet Yellen's printing of T-bonds to the tune of $300 billion a month, which is almost $4 trillion a year. Second, the massive holdings of cash by fearful money managers, which would act as rocket fuel for the market as it went up, and they were in the grips of FOMO, fear of missing out. But third, the overall panic with a fear and greed index of 18, which then in October last year was as close to the COVID market bottom of Q1 2020. Did that call work? Up to now it sure did. I hope you have stayed investment too. But stay invested until when? That too, I already noted in several clips since, but here's the gist. My most reliable sleuth informers tell me that the US administration is likely preparing for large-scale riots in mid-2024, say Q2, certainly by Q3 before the presidential elections. I will skip on the details here. But since the market always sniffs such things 3 to 6, sometimes 9 months in advance, this could bring in a market plunge at Q1 or Q2 next year at the latest. What will be the catalyst for the plunge? This no one can tell. It could be a bankruptcy of some private lender, or derivative blowing a gasket, or a major bank discovering its real estate is underwater. No one can tell. But the real reason, in my opinion, and the opinion of my sleuth informers, will be when the market sniffs the US massive riots coming up. How sure am I and they of that? Not completely sure. But as I told you before, I rank my informers on 5 criteria. Look it up. And the best of them tell me that the current US administration simply cannot allow Trump to be elected and execute his vengeance plan. Nor can they allow Bobby Kennedy Jr. to be elected and revenge the killing of his father and uncle. So, as in a Wild West poker game, when the pro player has a bad hand, he just overturns the table. By that time, when the market table is overturned, if the fear and greed index, which was below 20 in October, it can likely go to euphoria, say about 85 or 90 or even 93, where it was in December 2019. You think I'm sticking my neck out too much? Twice? First foreseeing a further 35% market rise here after the 35 you already had, and then on top seeing a huge market decline after? It is possible, of course. I could be wrong. But if there's one thing I learned, is that when a great opportunity knocks and is backed by the most reliable informers, I should act on it fully and not halfway. And there's one more reason I'm sticking my neck out now. That's the risk that I too will be caught in the euphoria next year and be tempted to overstay in the market. I hope I won't be. So by doing this clip, I'm ensuring that I wouldn't chicken out of selling everything when euphoria does hit, as I did do in August 87, but not in 2019. But do I really think the market can go up from last year's panic to full euphoria next year? Let's talk about it next year. That's all for today. Please subscribe to the channel, retweet to all your friends and followers that are subscribed to, and buy my investment books to learn how you can do some sleuthing yourself on your own, and also buy my latest thriller, The Undertaker's Daughter, which I wrote to keep myself from doing too much in the market, forcing myself to do only the most important stuff. I had fun, lots of fun writing it, and I bet you'll have fun reading it. And if you do buy it, please write a review about it for Amazon. I'll see you next time, and meantime, thank you very much for watching.